Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at Algobot, and today we're exploring a strategy called the Wick Asymmetry Trend Rider. This approach deliberately ignores where each candle closes and instead studies the rejection tails, the wicks, that price leaves behind. Over the next few minutes, you'll learn how it measures the balance between upper and lower wicks, how it uses a moving average to stay on the side of the trend, and how it manages every position from entry to exit. Let's get started. So what exactly does the Wick Asymmetry Trend Rider do? At its heart, this expert advisor is a trend-following strategy built around a single custom oscillator called the Wick Asymmetry Index. Every candle on your chart leaves two rejection tails. The upper wick is the distance from the top of the candle body up to the high, a probe upward that was sold back down. The lower wick is the distance from the bottom of the body down to the low, a probe downward that was bought back up. A single hammer or shooting star can be noise, so this strategy sums those tails over a rolling window of bars, 20 by default, to reveal a persistent footprint of who keeps defending their side of the market. The Wick Asymmetry Index takes the sum of the lower wicks minus the sum of the upper wicks, divided by their total. That produces a value that always sits between -1 and +1. When the reading pushes toward +1, dips are being bought back again and again, a sign of quiet accumulation. When it pushes toward -1, every push higher is being faded, a sign of quiet distribution. Around zero, the wicks are balanced and there is no hidden pressure. What makes this different from many candle-based tools is that it ignores the body of the candle entirely. A candle can close dead in its center and still carry a huge lower tail. And this strategy listens only to those rejected extremes rather than the settlement point. This expert advisor can be applied to any symbol and any time frame you choose at testing time, from forex pairs to indices and metals. It is designed for traders who are curious about order flow style thinking and who prefer a systematic, rules-based approach rather than discretionary decisions. Remember, this is educational information only, not financial advice, and trading always involves the risk of loss. Let's walk through the mechanics step by step. The Wick Asymmetry Trend Rider only acts once per completed bar, so it waits patiently for the current candle to close before making any decision. That avoids reacting to the noise of a half-formed candle. First comes the trend gate. The strategy calculates an exponential moving average of closing prices, using a baseline period of 50 by default. It then checks two things at once. It compares the moving average now against its value a few bars back, 3 by default, to measure the slope, and it checks whether price is sitting on the correct side of that baseline. For a long setup, the moving average must be rising and price must be above it. For a short setup, the moving average must be falling and price must be below it. This keeps every position aligned with the prevailing drift. Second comes the signal itself. The strategy measures the Wick Asymmetry Index on the just closed bar and on the bar before it. For a long, it looks for the index to cross up through the positive threshold, set to 0.20 by default, meaning rejection pressure has tipped decisively toward buyers this bar. For a short, it looks for the index to cross down through the negative threshold. Notice that it wants a fresh cross, not a reading that has been elevated for a while. That fresh cross marks the exact moment hidden pressure tips into the trend, which helps avoid late entries into moves that are already exhausted. When a long setup lines up, the expert advisor buys at the ask. When a short setup lines up, it sells at the bid. Only one position per magic number is held at a time. Now for the exits. The primary exit is an active momentum fade. The strategy closes along the moment the Wick Asymmetry Index slips back below zero, because the tails have stopped favoring buyers. It closes a short once the index rises back above zero. Behind that sits a hard backstop built from the average true range. The stop loss is placed at a multiple of the ATR, 2 times by default, and the take profit is set at a reward to risk multiple of that stop distance, also 2 by default. So the strategy carries both a responsive exit and a fixed safety net on every position. Let's look at the actual MetaQuotes language code that runs inside MetaTrader 5. At the top, we have the input parameters. WickWindow sets how many bars of wicks are summed, 20 by default. Threshold is how far the index must cross from 0, 0.20. Trend period is the length of the moving average baseline, and slope loop back is how many bars back we measure its slope. ATR period, ATR multiple, and reward risk shape the protective stop and the take profit, while lots sets the order size. Below that is the decision block. The variable uptrend is true only when the baseline now is greater than the baseline a few bars ago and price is above it. The variable downtrend is the mirror image. Then bull cross checks that the Wick index was at or below the positive threshold on the previous bar and is now above it, a genuine fresh cross upward. Bear cross checks the same idea for the downside. When uptrend and bull cross are both true, the code calls trienter for a long. When downtrend and bear cross are both true, it calls trienter for a short. In the long bracket, price is taken from the ask, the stop loss is placed one risk distance below entry, and the take profit is the reward to risk multiple above it. Then trade.buy sends the order. In the short bracket, price comes from the bid, the stop sits one risk distance above, the take profit sits the reward to risk multiple below, and trade.sell sends it. Both sides are symmetric, so the strategy treats longs and shorts with exactly the same logic. This is educational information, not a recommendation. Let's bring this to life on the chart. Across the top you can see the price candles, and running along them is the exponential moving average baseline, our trend gate. In the panel below sits the Wick Asymmetry Index, our oscillator, with a positive threshold line, a zero line in the middle, and a negative threshold line. Watch the opening candles on the left. Price is grinding gently higher, and the baseline beneath it is sloping upward, so the trend gate is already leaning bullish. Look closely at these early candles and notice their long lower wicks. Each time price probes down, buyers step in and lift it back, leaving a tail hanging below the body. In the panel below, the Wick Asymmetry Index is climbing as those lower tails accumulate. On the third candle, the index pushes up and crosses cleanly above the positive threshold. This is the fresh cross the strategy has been waiting for. The baseline is rising, price is above it, and rejection pressure has just tipped decisively toward buyers. That is where the buy entry marker appears. The expert advisor buys at the ask and immediately places its protective stop one average true range distance below, with a take profit set at twice that distance, our 2-to-1 reward to risk arrangement. Now follow the next few candles. Price accelerates upward, each candle closing near its high, and the moving average baseline keeps sloping up underneath. The move runs in the strategy's favor until price reaches the take profit marker higher up. The long position closes there at its target, having ridden the wave of accumulation that the wicks quietly signaled before the body ever confirmed it. After that peak, the character of the market changes. Watch the candles roll over. Now the upper wicks start to dominate. Each attempt to push higher is sold back, leaving long tails above the bodies. The baseline flattens and begins to slope downward, and price slips beneath it. The trend gate has flipped from bullish to bearish. In the panel below, the Wick Asymmetry Index is falling fast. It crosses back below zero, which tells us buyers have lost their grip, and then it drives lower still. On this candle, the index crosses down through the negative threshold. The baseline is now falling, price is below it, and the fresh downside cross lines up with the trend. That is where the sell entry marker appears. The expert advisor sells at the bid and places its stop one average true range distance above, with the take profit twice that distance below, mirroring the long exactly. From there, follow price down candle by candle. Sellers stay in control, each bar carving out a fresh low, and the upper wicks keep signaling rejection of every bounce. The baseline slopes down the whole way, keeping the strategy on the right side of the drift. Eventually, price reaches the lower take profit marker, and the short position closes at its target. Notice what the oscillator did throughout. It did not care where each candle settled. It only measured the balance of the rejected extremes, the wicks above versus the wicks below. When lower tails stacked up in a rising market, it climbed and signaled the long. When upper tails stacked up in a falling market, it dropped and signaled the short. And remember, even though we did not need it here, the momentum fade exit is always standing by. Had the index crossed back through zero before either target was reached, the strategy would have closed the position early rather than waiting for the stop or the target. That is the full rhythm of the Wick Asymmetry Trend Rider, one long and one short, each gated by the trend, each entered on a fresh cross, and each protected by an average true range bracket. Of course, not every setup plays out this cleanly in live markets, and losses are a normal part of any strategy. That brings us to the end of our deep dive into the Wick Asymmetry Trend Rider. We covered how it measures the balance of upper and lower wicks into a single index, how it uses an exponential moving average as a trend gate, how it enters on a fresh cross of the threshold band, and how it manages risk with a momentum fade exit and an average true range bracket. Everything you have seen today is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment with the strategy you would like us to analyze next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.